we're going into the hockey helmet for some question and answers. I'm a first-time buyer looking to move out of my parents' home. I don't have much of a down payment, but my income has increased substantially over the last 2 years. That being said, I am trying to convince my parents to look at taking out a reverse mortgage on their home, but they are not budging. How would you pitch my parents on taking out a reverse mortgage to help me with a down payment? Well, first of all, we have to find out how much your parents love you. And are there other siblings in the picture? Because the reality is, a reverse mortgage is an erosion of equity to a degree. I think reverse mortgages have a purpose. And if a parent is not willing to provide you a down payment, there's probably other forces and a reason for it. Now, they are housing you. Maybe they don't want you to leave. Maybe they want the company. I don't know. But this is a question that I would not harbor to suggest any tactics to convince your parents to get a reverse mortgage unless I knew more information. Like, I'd want to meet your parents. I'd want to understand what their goal is. I want to understand, are they staying in this home a long time? Are there other siblings that they want to help as well? Like, there's a lot of missing information and something that I would need before I can make any comfortable suggestion. So I'll leave it at that. Has the volume of new mortgages reduced? Okay, very good question. I always track my Equifax bill to determine how our activity is going. And our Equifax bill has been pretty constant over the last little while. We are seeing a lot of mortgage applications. We are seeing consistent levels. And as of the middle of October, we're pretty much a little bit ahead on applications funded year over year. Our volume is a little bit slightly less than last year, and our revenue is down about 17%. A lot of that has to do with shorter term money. We're not charging as much for folks that need private money. We're trying to be fair and equitable, really trying to shave fees to make deals happen and help people out. And I think that has a long-term benefit for relationships when you don't kick a horse when it's down. So we are still seeing a lot of activity. It's tougher deals, a lot more difficulty trying to put things together. Values aren't coming in. Situations are dire. And the revenue's down. Applications are up. Volume a little bit down because mortgages are a little bit lower than they were last year on an average basis. But the revenue is down. But all good. We're here. We're active. We're staying busy. And the activity is keeping us in a situation where we're helping folks, we're giving them advice, and sometimes we do feel like pro bono legal aid lawyers, where we're trying to do our best to provide advice with no end transaction, but a plan and a strategy for folks to get out of a mess and get them through this difficult period and try to keep them in their homes. But thanks for that question. I have a renewal coming up next month, and the bank has offered me two terms. One is a 3-year fixed rate at 6.35, and the other is a variable rate at prime minus 60, which would be 6.6 at the moment. I don't plan on selling this property anytime soon, and I'm wondering what you would suggest in this situation. Okay, we get this question a lot, but before I can answer questions like this, I really want to know exactly how much debt people are carrying, what their income is, and what their long-term plan is. In this particular case, they're indicating that they're not selling the property anytime soon. So it's a long-term hold. What I don't know is how much they earn, what their payment is, and what the mortgage amount is relative to the value of the home. That is critical, because if they can understand the risk associated with a variable and the possibility of that continuing to go up, then they can potentially seek out a variable. But the 3-year at 635 is less than that variable today. And depending on when this matures, I would wait until the October 25th meeting to see if there's a further hike. Because if there is a further hike and then it's going to be higher for longer, then I would probably lean towards the 3-year at 635, because there'd be additional savings to the 25 basis points at the moment. But a lot of details and variables not mentioned in this question, and one that I would need to provide a solid answer and something that I could recommend with confidence. What are your opinions on the Airbnb market in the GTA, and do you think it's worth taking the risk of not having that reliable tenant every month? Well, this is a really interesting question because out in BC, they're starting to ban Airbnbs, and you wonder if this will trickle over to GTA. And if it does, it creates a significant problem for those folks that rely heavily on increased rents to carry their debt. So if you are making an investment on the basis of Airbnb, which could be scrapped and enforced, how does that make your investment turn out in the long run? Listen, I think you have to make sure your investment is sound. This is a risk. Understand your risk, understand the downside of your risk, and just remember that things could change. And with housing being a challenge and Airbnb taking up a lot of the rental stock, it will be a target of politicians to try to curb a situation that can't be easily replaced. Housing is difficult to build fast. And if they have an opportunity to get rid of Airbnb in the city to free up units for full-time rentals, believe me, politicians will try to start taking aim at them. So be very careful on whether your whole investment plan is based on this, because it could go down in flames quickly with a political policy. Are you seeing an increase in defaults yet? Not really. We're seeing people under stress. We're seeing folks having difficulty making payments, but we haven't really seen that much in the form of foreclosures and power sales. We are speaking to clients about thinking about getting out of the mortgage and selling their home and taking that equity and maybe doing something else. You know, they're hesitant. They don't want to uproot kids at the beginning of the school year, and they're taking a look and seeing what is available on the rental market. The challenge a lot of them have is they don't even qualify for a lower mortgage because the stress test has created so much of a challenge. But we are seeing people start to think about selling. And in today's day and age, I think homeowners are more informed than ever. I think they're getting ahead of it. They're feeling it. And remember, credit cards, car loans, lines of credits are the products that see the first sign of delinquency. We're starting to see that creep up. And the mortgages are always first to be paid. So we have seen some NSFs in our mortgage investment corp, more than usual, but under control. And we're starting to see the cracks. We're starting to see things break. You're starting to see developers starting to see projects go into receivership, as we talked about earlier. But the reality is we're not at that point where things are dire. We're seeing things causing stress, causing anxiety, and causing a lot of frustration in families. And, we're going to continue to monitor that, and I'll give you an update as we go on. Has there been an uptick in foreclosures, or has all the big banks being told to work with homeowners? Okay, this is a good question, and one that we just talked about on the show. The number of foreclosures and power sales on TREB as of beginning of October was just under 150, not a significant number. There isn't a whole lot of power sales on TREB right now. And I do believe lenders are trying to work with clients, okay? They are trying to provide them with tools and strategies to help them through this difficult time. And I always encourage clients that are struggling, be proactive. Share your problem with your lender. If you are anticipating running into any type of difficulty, let your lender know. Lenders aren't in the business to kick you out of your house, okay? They want to try to help you out. And I could tell you that a lot of lenders want to put their best foot forward and give you a plan that can work, okay? Now, if you avoid them, you don't return their calls, and they're chasing you, they're not going to want to help you. Okay, but if you're proactive and say, listen, this is a situation, this is what I'm anticipating, I need a hand, chances are they're going to work with you. So be proactive. And right now there isn't a whole lot of foreclosures relative to the amount of mortgages that are on the books. My mortgage is coming up for renewal in the spring, and I have just recently been advised that my department is being moved offshore. I have been on an accelerated payment plan and want to know if I can stretch my amortization to the maximum 30 years. Okay, there's a lot to unpack there. So it looks like somebody is coming up for renewal. They're going to be losing their job and they want to extend their amortization. So this is a really interesting situation, because if you are proactive in speaking to your lender about situations that you're anticipating, as I mentioned in the previous question, you have some runway here to start planning for it. Now, I do know, in light of what's happened with the static payments, a lot of people on variables that are going backwards in amortizations, lenders have been instructed to work with their clients to come up with a solution. So if you are on a 25 or 30 year amortization that you started with, and you've accelerated your prepayments, your payment schedule, so that you're ahead of the curve, you have room to back it up, okay? So keep in mind, lenders are very keen to reward those folks that have been doing a good job. So when you have a situation like this, there's a likelihood, a very strong likelihood, that the lender is going to work with you. So what I encourage you to do is contact your lender, find out what options are available, and you now have quite a bit of runway from now until the spring to come up with a plan and a strategy that could work for you. How difficult is it to buy out a spouse due to a marital breakup? This is an interesting question. My associate Norbert and I have been working together for 22 years, and we've found an interesting trend. It's not something that we've tracked, but it's something that always pops up after Thanksgiving. And there is a high level of marital breakups after Thanksgiving, okay? And we get this all the time. We get clients who call and say, Barb and I are breaking up. I'd like to buy her out. I'd like to sell and buy 2 properties. We get this all the time. I don't know what it is. I don't know if it's the turkey dinner. I don't know if it's someone just not wanting to see the in-laws again at Christmas time. I don't know what it is, but there's definitely a trend happening, and we get this all the time. So if you're looking to buy out a spouse, first of all, it's important to have a separation agreement. You need a document to drive the decision, because the lenders who are looking to refinance or help you buy them out want to know what the arrangement is. They want to know if there's any payment obligations and alimony, if there's any child support, because they have to factor that into the qualifying criteria. And it's becoming a lot harder. You have to remember that when you took out the mortgage, you had 2 incomes. Now you only have 1. And you have to probably buy out a big chunk, if you've been together for a long time, of equity. So it's going to be very difficult. It's not impossible, but you have to have all your ducks in a row. You have to requalify. You have to make sure that you pass the stress test, which is the qualifying tool required to grant you the mortgage. And it is cumbersome. It is a little bit more difficult, but one of the key things is, do you have a separation agreement? Because that's going to drive the decision, and it's going to dictate how much exactly you have to provide the spouse to buy her out, because that spouse is not signing off a title until they get what they're entitled to. So always make sure you have those details. And we do some preliminary work for clients as well when this is new and fresh and raw, but for the most part, nothing could get triggered unless there is a separation agreement. So I would encourage people to try to get that done ASAP. As a first-time buyer with a good down payment and strong income, when should I buy and what type of property should I consider? I think you want to be patient. I think what is very interesting in the current environment is that more and more properties are up for sale. And that provides any buyer more choice. As a first-time buyer, you want to start thinking about how you could take advantage of this market. Do you want to get just a forever home? Do you want an entry level? What do you want to gain out of this experience? And that is key to determining which route you go into. I am not a big fan of condos right now. I've fallen out of favor of that mode of housing. I just think that there's just too many issues on the horizon that could cause problems for that segment. And I don't want to get into it now, but that's just my opinion. Okay, I really like the low rise. I really like the fact that the new legislation being passed, the zoning bylaws to allow multiple units on property, is a strong and very important aspect when thinking about what property to buy. Because all of a sudden, if you do have a low-rise home, you can improve it, you can repurpose it, you can add value to it by increasing the number of units that could be within that structure. And that can earn you income. It could provide you an opportunity to help you with additional rental income. And I just think long-term, it becomes a more valuable asset. In terms of investing in real estate outside of Ontario, do you think there's opportunity in other provinces in Canada, or should I focus my attention on the United States? Rates are high. I think you want to be patient. I think you want to understand any market that you're entering into. And you have to really understand that there is a currency risk when you move south of the border or you move into an investment vehicle in the States, okay? The dollar is sinking, and we are going to pay more for a U.S. property than we did a year ago because the dollar's dropped. That 4, 5, 6% could be all the difference. And when you're buying a property in the U.S., all your payments, all your costs are in U.S. dollars as well. So you need to understand what the tax consequences are, as well as the currency risk, and determine if it's something that makes sense. Speak to accountants, speak to cross-border accountants, speak to your lawyer, understand what the estate laws are if something happens. These are all critical before you make any investment anywhere. And as far as out of province, you really need to understand what's going on. A lot of people are moving out to Alberta, a lot of people are moving out east. There are non-resident, non-provincial resident taxes out east, from what I understand. There are other consequences that you must be aware of, so be informed, do your research, try to understand exactly what you're getting yourself into. And as far as Alberta is concerned, are we at the top of the market? Understand where we are in the cycle before you make any decision, but be patient, do your homework, do your due diligence before you do anything. And if you need any help financing, give our office a call, we'd be happy to help. Regarding the new bill passed in Vaughan, allowing 4 units on one lot, do you think areas that build these fourplexes will cheapen the area with all those renters? Okay, it's a good question. Something that has come up quite a bit on a previous post. I had a lot of comments about this. People are saying, oh, this is going to be terrible. The neighborhoods are going to go to shit. Number one, these units have to meet code. Okay, you can't just jam 20 people in the basement, okay? A lot of these legal units need to pass code. They have, certain egress requirements. They need double doors. They need to be fully approved by the city in order for them to be legal. And I could tell you that it's not going to be as easy as you think, okay? We are involved in a number of projects, but the inspectors have to come through at every stage of the process. There's no shortcuts. They want to make sure these are legal units that have proper ventilation, proper lighting, proper emergency exits, and whatnot. So as far as, will neighborhoods be overrun with these? I doubt it. I don't know if everybody has the resources to convert these things to proper legal units. So we do need units. It's one tool the government is using. I think it's a positive. We're one of the countries that have the largest square footage per occupant in the Western Hemisphere. So for the most part, we live in pretty big units to begin with. And a lot of these units will be a lot larger than the 450, 500 square feet crates in the sky that we call condos. So I don't think it's going to be a negative. It may cause some congestion on the streets if people need cars to get around, but with the advent of new transit coming into Vaughan, I think this is a good thing. Things are starting to get a little bit crazy out in the real world, and now more than ever, we really got to band together and try to be as Canadian as we used to be. And I don't mean that in a negative way, but you know what? We got to put down our differences and try to all get along, okay? A lot of this stuff going on just doesn't make any sense to me. And if you have the ability to help, give somebody a helping hand, just do it. The world needs it, and we need it more than ever in this environment. So on that note, I wish you all a wonderful weekend. Enjoy the sun and get out there and enjoy the last of this wonderful weather. Take care. Have a good one.